Last week was our first playoff game, and my plaque psoriasis was so itchy under all my gear. Sometimes just thinking about scratching could take me out of the moment. And then my doctor told me I could get clearer skin with a pill called Otezla.
Otezla Apremilast is a prescription medicine used to treat adult patients with plaque psoriasis for whom phototherapy or systemic therapy is appropriate. Otezla can help you get clearer skin after just 4 months.
Okay, ready for the next game. Talking to my doctor about a pill was a total game changer.
Don't use Otezla if you're allergic to it. Get medical help right away if you have trouble breathing or swallowing, swelling of the face, lips, tongue, throat, or arms. Severe diarrhea, nausea or vomiting, depression, suicidal thoughts, or weight loss can happen. Tell your doctor if any of these occur and if you have a history of depression or suicidal thoughts. Live in the moment. Ask your doctor about Otezla. Call 1-844-4-OTEZLA or visit Otezla.com for prescribing info about cost, and more.
Reality radio for a really great future. We're talking real money.
Well, hello again, and welcome to another incredibly exciting and illuminating edition of the show called Talking Real Money, because what we do is talk about real money and real money issues and real investing and some really important stuff. And we invite you to ask us questions about your financial situation, particularly about investments and investing, at 855-935-TALK. That's 855-935-8255. We, Tom and I, have been helping folks like you all over the country make better financial decisions. The information we give, we strive to make it always in your best interest, to give you advice that is truly actionable and honorable at the same time. So give us a call, 855-935-TALK, 855-935-8255.
I haven't seen you this excited since the Denver Broncos were a potential Super Bowl team. I haven't seen you this excited since your national show was headed to Disney. I haven't seen you this excited since we stopped into that one brew pub in Portland that they threw us out of after several hours. This is... Wow, you are really...
That was younger days.
That was a long... I just figured... I ran the number.
Wow, that was younger days.
That was like 25 years ago. So, sorry.
But I've definitely both aged and matured since then.
Indeed, both of us have. So, I mean, we'll promo this a bit.
Did we get kicked out?
They kind of gently asked us to leave. It's Portland.
Yeah,
I mean, they don't really throw people out of there. But
now, I do remember way back when at a National Association of Broadcasters conference, it was like 1989 in Boston, and our general manager of the Business Radio Network was apparently at the time we were flush with cash, investor cash that eventually got spent and the thing went bankrupt. But at the time, I guess he was feeling wealthy, and he was buying drinks not just for our entire company at a bar in Faneuil Hall, but he bought drinks for an entire marching band that walked down the street.
Wow.
And there were so many drinks, and they flowed so quickly and readily that we were denied entry to bars. It was like, no, you are not coming in to our bar. No.
Now that's something. Yeah, I mean, you get thrown out, but getting thrown out before you even get in, now that's
before
unusual.
You even get in the door.
That's unusual. So,
but that was younger days.
Well,
that was younger days.
I'm promoting something that we've got coming up in a couple hours.
That's on the other station.
I know.
Should we do that? Is it fair?
No, I'm just saying we will promo. This is a tease to the tease. So you're really worked up today. I mean, this is like Don McDonald on steroids.
I don't like it when someone misleads the investing public.
Yeah.
You know that. It has always bothered me. But it really bothers me when the person doing the misleading is someone who was, for an extended portion of his career, a respected journalist who sold out. And I'm not happy about it, and I'm going to be interviewing him. And I told him there's no sandbagging here. I said, I want to ask you about the Ponzi scheme that you recommended on your radio show.
See, now that's where you're a nicer person than I am, because when I had the TV show, people would forget that they'd done certain things, and then they'd call and say, can we do an interview? Sure, that's a good topic. they'd come on. I'd give a couple of questions about the stuff they wanted to talk about. Then we go into the things that they've forgotten that were public information, by the way. And then we'd go into those, and it didn't end up very happily for the interviewed party. Let's put it that way.
My problem is I'm going to start with the bad stuff.
I know you are.
And then after a ton, I mean, I have researched this topic
really
for the past couple of days.
Yeah.
It's going to get worse from there because I've discovered stuff about all his other stuff that if he doesn't hang his head in shame when I'm done, the man has no conscience.
Well, and here's the bottom line for me about all that.
Yeah.
He was promoting something that was, I think, promising 8% a year returns safely.
Yeah. Oh,
that blew up.
You want to hear a direct quote from the email he sent me? This is what he wants to talk about on the show. Instead of keeping your money in the bank, this is a direct quote.
Right, in the bank.
Instead of keeping your money in the bank earning 0%, the blank fund would be a suitable alternative that pays 8% a year.
Okay, I mean, really? That just doesn't
8% a year.
Pass the
That's an
smell test.
alternative.
Well, and my question to him will be, if that were true, there would be no public stock market. There would be no bond market. There'd be no mutual funds. There'd be no hedge funds because even the really smart guy on billions would just take all the money and hand it to him and say, give me my 8% every year safely because, come on, that just doesn't make sense. There would be trillions of dollars in an investment like that. There would have to be. All the money would flow to something like that. So, and by the way, I also do want to mention at the other side of the break, we have really great news for you. This is one of the biggest banks in the world is telling you how to invest to beat the market. Their words, not mine. This is huge. Big news.
It's about time somebody had advice to beat the market. Yeah, like no one ever does. 855-935-TALK's the number.
Tom and Don are talking real money.
If you're sick of investing through an insurance agent or a stockbroker and you're in the market for a fee-only advisor who charges truly low fees and uses a scientific approach to building portfolios for your risk tolerance and need, you should check out Vestory. Tom and I started this firm, and it is devoted to educating everyone, total transparency, clarity, low fees, and great service. If you're looking for an advisor, you ought to at least take a look at us at Vestory.com. That's Vestory.com. Or give us a call, 800-386-3004.
Your guides to a really great financial future. Tom and Don are talking real money.
Yeah, you looking for a way to beat the market? Well, give us a call, 855-935-TALK, and let me just give you a little hint. We'll tell you the truth.
Whoa, wait a minute. Now,
others might not.
You're suggesting
and I'm not naming names.
Well, I'm going to name a name here in a minute because they went
Bank
public.
of America?
Yeah. I mean, okay, Bank of America, not as bad as HSBC because I just watched them on Dirty Money the other night. So that could be their moniker. Not as bad. That was an eye-opener. Holy cow, I got to pay more attention.
And why do these banks have to be so bad? Why is it? Why do they just have to behave so badly? It appears to me that they're conscience-free. They're just like missing that part of their soul.
The thing I loved about HSBC is they get caught over and over again, and then they pay these. They say they're sorry. Shouldn't have done. They were laundering drug money, etc. They're sorry, and then they pay, I think somebody said it's like 1 month worth of profits in a fine.
Yeah.
And then they go on, and no one goes to jail. It's just like business as usual.
Bank of America, Merrill Lynch, Chase, Morgan Stanley, all of them have paid hundreds of millions, in some cases billions of dollars in fines.
Then you're going to love this piece because Bank of America is going to return some of that money.
Show me that. Does it say beat the market?
Bank of America outlines tips investors can use to beat the market.
Jeez.
And by the way, here's a suggestion to Bank of America. If they know how to do this, they might. There's a brokerage, I think it's down the hall or across the hall called, it starts with an M, I think. Merrill Lynch, that's it. They might want to go help them first. But
Why would you tell me, Bank of America? Why don't you go make a lot of money on these tips?
Because they're giving back after the big fines you just mentioned. This is their way to help the public. So here are their, by the way, I love this quote. Absolutely love it. I got to find it now.
Yeah. Do you want me to find it
One
for
of the
you?
biggest challenges is from Bank of America quantitative strategist. One of the biggest challenges for active managers has been a substantial shift to passive investment strategies. By the way, you would think that would be good for the active managers because now there's less money. With less money, you could trade more and make more money. But here's what she says. The best way to slow or reverse this shift is by generating alpha.
Yeah. Oh, wait. Let me translate. Wait. So the best way to make active management work is to start making money actively managing.
It's why
basically admitting that it hasn't worked so far, but we keep trying.
That's the Department of Redundancy department, I believe. But anyway, so if you
the
just
way to
make
be successful
more,
is to be more successful.
then thank you. That would be the way. And so they give you a couple of great recommendations that investors can use to outperform. This straight from Bank of America. I just love this.
Okay.
Investors should focus on parts of the market with more return volatility. Don, what is return volatility? What does that mean?
Oh, buy the stocks that fluctuate more, that are riskier.
There you go.
Buy the riskier stocks.
Only, of course, buy the ones that go up. You don't buy the other ones.
If you're going to buy risky stocks, let me just give you a bit of advice. Do not buy the ones that go down more than they go up. No,
she recommended, by the way, and this might shock you because it hasn't done very well this year, technology. I'm kidding. It's been killer.
Had a good week.
Healthcare and consumer sectors as a quote now, stock pickers paradise. How many times have we heard? Didn't Jimmy Buffett turn that into a song, Stock Pickers Paradise?
No, that was Stock Pickers in Paradise.
There they are. Okay, number two.
Well, you know what the old title used to be?
What?
And it didn't go over well. It was Nose Pickers in Paradise.
Oh, yeah,
and he
it's
went,
not nearly as
wait,
popular.
I bet I get more play if I say Stock Pickers in Paradise.
All right, number two.
And then I'll open up a community in Orlando.
Number two is, I love this, take the road less traveled. Investors are more likely to find bargains in areas of the market that are less covered by Wall Street analysts because you can find this is my words, the inefficiencies that allow you to trade in a way that nobody else knows about.
Would that be the dark web or something?
It's the dark web.
Subterranean markets?
The more eyeballs on the stock, the less alpha you're likely to harvest, she says.
In this day and age,
That's
with
my point.
everybody, what market is not being followed by analysts?
By a lot of analysts spending a lot of money, yes.
That would be the Rwandan Stock Exchange.
Okay, but that is still not as important.
But I've sent my daughter there to do some research on it.
This is still, I think it's Venezuela, but there's hidden gems there somewhere. You just have to find them. Here's the most important one.
The hidden gems are the more volatile winners.
Yeah, it's hard to find those right now in Venezuela. Maybe this is the most important one. Mm-hmm. Extend your time horizon. Short-term trading hurts returns because of higher levels of competition. Alpha, that's outsized performance over the benchmark, over short time horizons has become increasingly hard to come by. It's harder to beat the market over short periods of time.
No, actually, the numbers. No, now what's funny about that is that S&P's numbers, the SPIVA numbers, show that it's harder to beat the market over long periods of time.
But what I laugh is that sounds like a buy and hold strategy. If you buy securities and you hold them for a long time, then no, doesn't
That's
it?
Just all of that is, and here's the thing that I don't get is because they're Bank of America. They get press for that.
Yeah.
They get
a major
press
story
for that
on
ludicrous
cable
advice.
channel.
CNBC. Yeah, I'm looking at it.
Okay, I wasn't going to give them the pleasure of mentioning. So
I because usually in the same breath I go, CNBC, don't watch it. CNBC, don't watch it.
Okay, so
you
for
want to
those
waste
of
your
you-
time? Watch CNBC.
those of you new to the program,
yeah?
we were mocking this, just so you know, because a guy did ask me a couple weeks ago, you said that, and then I said, no, I was mocking it. We're mocking this.
Really? Wait.
Somebody said that. Yes, they did.
Someone actually took what we said seriously?
Well, there is that, but this is just really funny. I mean, folks, Bank of America doesn't beat the market. Merrill Lynch spends more, as my recollection was at one time, spent more on individual stock analysis and did worse than all the major players. And the people that spend billions on this underperformed indexes. So no, they don't know how
funny-
to do this.
I was doing some research this week on trying to find outperforming active managers, because the big claim is that active managers do well in down markets.
Right.
Well, Vanguard went back and looked and found that active managers only beat their benchmarks in a couple of bear markets. Most of the time, they still underperform their benchmarks. And by the way, when we mean beat their benchmarks, that means over half of them do in that bear market, not a lot of them. It's still a lot don't. They fail miserably, just the abject failure. So this business about beating the market, it's a game you play as listeners. It's a game, by the way, I, as an old stockbroker back in the day, played.
Very
thinking you could beat
old
the market.
stockbroker.
Yeah, just rub that in. Just rub it in. But I learned early on that beating the market was difficult. Then later on, I learned that beating the market, based on tons of statistical academic research, that beating the market is not just difficult, it is nigh on impossible, particularly when you're faced with the task of picking those few who outperform over and over again.
Tom and Don are talking real money.
If you need help allocating your retirement plan at work, you can get free help at 401-411.com. That's 401-411.com.
For your real life and real future, Tom and Don are talking real money.
Because it's really important, and it's really not talked about properly that much. I mean, go watch CNBC. No, don't watch CNBC. Yeah, go watch it and then stop watching it, because there's nothing there of value. Zero there of value. Not one thing. Nothing.
Well, no, they have that nice
late
thing that moves across the screen.
Don't watch that.
Oh, okay.
Don't watch that. You can watch the shows late at night as long as you don't watch Susie Orman. Ugh. 855
Now you're going to pick on Susie Orman? Wow, you're really...
I will pick on Susie Orman too.
All right. Well, we could talk about her investing.
Oh, her investing.
It hasn't been very
terrible.
good. Yeah, it's not been very good.
855-935-TALK is our phone number. That's 855-935-8255. And now off to the phones we go.
Yes.
And Paulo, welcome to the show.
Yes.
How can we help you?
Okay. You said Paula?
Yes, you are on the air.
Okay. Okay, thank you. I didn't expect to come up this fast.
Okay.
Okay. So my question is, I retired a year ago, and the institution that I retired from had a pension plan for their employees that they put into, and it was just it was a 401k, but it was just a small amount. But we were told at seminars that were offered at the institution, the best way is to just take whatever they put in and don't put your own money into it, which I didn't at the time. We were raising kids and other things going on. So, but then they froze that pension plan and changed to a different one that if we wanted to see it grow, we had to add to it. And so, and that was about 2013 or 2014. So I did start doing that, but and they would match a certain percentage up to a limit.
I'm going to hold you here for a second, Paula, because your nomenclature is confusing to me. A pension is completely different than a 401k. A pension is something,
I get it,
a company-sponsored plan. A 401k requires a contribution by the employee and oftentimes gets a match from an employer. Those are two completely different things.
I get it. Okay, so the first one was just a pension.
Okay,
but it wasn't.
Right. Okay, so we have the 401k and the pension. So what's your question around these guys because of our time constraints?
Exactly. So what I need to do is I have two different accounts.
Yep.
The one that was frozen, that was the original one, and then the one that I started up. And now that I'm retired, a year later, they are still there, though they aren't being contributed to by my employer anymore, and they're growing. But I need to know which I roll into first, which one
How much
I roll
money?
over
How much
into the
money's
other
in
one.
these guys?
How
And
much
what the old-
How much we talking about?
One has the original has about 54,000 in it,
Uh-huh.
and then the
The 401k.
the 401k has about 18,000 in it.
Okay. Now, what is it that you are hoping to derive from this $70,000 or so?
Right. I need to know what steps I need to do, and mostly I would like to use. I already have a pension through my husband's retirement, and
Do you
He
need an
retired
income
from-
from this money?
I don't need an income. And what I'm thinking is I would use it. We plan to sell the house we are currently in down the road. I would like to use it to, say, pay more towards the house that we
Okay, we're not going to want you to do that because you're going to pay tax on it. I mean, here'd be my suggestion is to put those into a individual retirement account.
I
Manage it
concur.
in a way. We give out 2 free funds, the Vanguard Total World Stock Fund, the Vanguard Total Bond, balance between those two, build for the future. I wouldn't take it all out, though, and pay off your house because you're going to pay
No.
tax on that.
No, I wouldn't pay off a house anyway. I don't think that's the best investment you can make.
Tom and Don are talking real money.
We mention 855-935-TALK, 855-935-8255 throughout the podcast. But you need to know that you can call that number 24 hours a day, 7 days a week. Leave your question, and those will be answered in special Talking Real Money podcasts that will appear on this particular site in the future. So give us a call, 855-935-TALK, 855-935-8255.
Reality radio for a really great future. We're talking real money.
Our number again is 855-935-TALK, 855-935-8255. We're here to make money, make a little more sense, and to try to help you make more money by not playing with your money. Don't play with your money.
Yeah, and let me just finish the spot on Paulo there very quickly. Number one, I find for most people in retirement, having one retirement account makes sense. If you have a small amount in a pension that could be moved to an IRA, for example, it probably makes sense to do that. If you had a small 401k, combine that, and then you know what you have set. Number two, you never want to pull money out of a tax-deferred plan that way and pay tax. And you're going to pay tax on it and then pay down a home mortgage, which is going to be a very low interest rate anyway, generally. And if you don't need it for your living expenses, probably just letting that grow till 70 and a half and taking out the required minimum distributions on that money makes more sense.
Yeah, and to add to that, I just don't really, except for the psychological peace of mind it provides. I don't. When you're in retirement, the odds of you staying in the same house that you go into retirement in for the rest of your life are not particularly good.
That's not always true. My wife has found a spot for me somewhere 200 yards out in the swamp. She says it's there. It's all set. I could be there for a very long time. So
hanging out with the coyotes.
There you go.
Or the coyotes. Is it coyotes or coyotes?
I don't know. I'll check in later when I see them this afternoon.
All right. 855-935-TALK. That's our number. Stop by. We'd love to try and help you make more money out of money. Make more money out of your money. Jim, you're up next. Welcome to Talking Real Money.
Hi, Jim.
Hey there. I have about $500,000 in a 401k, looking to retire in the next year or so. I'm about 58 years old, so I'm going to be able to go early. I have some other supplemental income from rental properties. But I'm wondering what I should use as an income percentage for long-term forecasting for those funds.
Are you saying income percentage or amount of growth in the portfolio, return on your money?
Let's say return on my money.
Okay. Well, I mean that is
beat the market.
Yeah, okay, we're gonna get to that segment a little later. But seriously, though, how much risk do you want to take with the money? For example, if you put it all in a globally diversified stock portfolio and you took the time machine, went back to 1970, and held that through the end of 2017, you would have made over 12% a year. Not every year, and some years would have been perilous, like 2008 or 2001, etc. So most people who retire want to have some fixed income or bonds. In a 60-40 portfolio, again, you've done really, really well. You've made double digits for that period of time. I would not expect that going over the next 47 years. But the question to you, to anybody, is how much volatility are you willing to take? How much are you willing to see your $500,000 go down by? I'll ask you, are you okay waking up one day and seeing your $500,000 at $400,000?
Early on, yes.
Okay,
because that's what I've struggled with is I can't just put a 3% on there for the next 35 years.
Not unless you wait and hear from our guest later who tells us easy to make it 8% a year safely.
That's a guest on the other station,
which
though.
We're
it's
not
on
promoting.
KVI.
If truly, you're retiring young, so you want to have good exposure to stocks because you're going to need growth in that portfolio. And if you told me you're okay with a loss of 20% of your principal at some point, I personally would probably do something 60% in stocks, 40% in bonds, and anticipate a growth rate of somewhere between 5 and 6% a year in a portfolio like that.
Okay, so if I put 4%, I'm still talking pretty conservative.
In terms of growth, in terms of growth on the portfolio,
if you have equities,
sure.
If you have equities in your portfolio, 4% has historically been a relatively conservative number. We don't predict the future, but we can tell you that looking back at the past, that's been a reasonable.
By the way, the thing to pay attention to about 4%, the real return then is somewhere between 1 and 1.5% a year. You're really only beating inflation by a very small amount.
Right. No, I understand that.
Okay.
My spreadsheet's about 3 feet wide.
Maybe you got a new job ahead of you there. You can be the stock analyst. So, no, I think yes, 5% a year in a relatively conservative portfolio for a long period of time is probably reasonable. No question. Thanks for the call.
Thank you very much. Appreciate it. 855-935-TALK is our phone number, 855-935-8255. And the thing Tom is alluding to at a little after 2 p.m. Pacific, we are going to be doing an interview over on KVI 570 AM. Yes, we will plug it because now all you're going, what in the heck are they talking about? That's what we're talking about because we're talking real money.
Tom and Don are talking real money.
Keeping the podcast breaks as painless as possible is my goal. That's why I want to very quickly tell you about the only magazine I've ever heard of that is 100% real investing all the time. There's no business news, no speculative advice, and certainly no lifestyle stuff. It's called Real Investing Journal. I publish it every quarter, and you can get 2 full years for only $25 at realinvestingjournal.com. That's realinvestingjournal.com.
Your guides to a really great financial future. Tom and Don are talking real money.
And if you hear a commercial for gold, it's not our fault. We don't believe gold is a good investment, period.
Unless you're wearing
don't
it.
Like it. It's not even a good investment then.
No,
it looks nice.
That's true.
855-935-TALK is our phone number, 855-935-8255. And Matt, you are up next. Welcome to Talking Real Money.
Hi, Matt.
Hey, how you guys doing?
We're having fun.
I understand you're trying to, speak to the whole general crowd, but I just want you to know that there are active traders that actively manage their accounts, and they crush the market every day.
Really? They crush the market?
Yes. Send me the track record. Show me the tax returns.
Why do then all of the actively managed mutual funds fail so miserably to beat the market? If one individual can do it, why can't that then translate into a mutual fund?
Or the really smart money in hedge funds where they just lost to the 10-year track record against the S&P.
So you guys are saying that Warren Buffett is just full of it? He doesn't outperform the market every year?
He doesn't, actually. Actually, no, the reality is he does not outperform the market every year. He doesn't.
And
look at the numbers.
Told his spouse, when I die, put it all in
the money in the S&P 500
fund.
Guys, I tell you what, I'll exchange information with you offline if you want to, but I crush the market every month.
Okay, we are
happy. And wait, let me just tell you something, Matt. There have been numerous studies done. The Swiss Finance Institute did a study. Fallman French did a study. Barber and Odine did a study. They all found that a tiny fraction of traders outperformed. But they were able to attribute the vast majority of that outperformance to luck. It depends on the study you looked at, but somewhere between 0.6% and 2% of active traders showed something that appeared to be skill. So if you were lucky to be in that 0.6% to 2%, congratulations.
We're just
but if we tell the rest of the world to do what you're doing, we'd be massively irresponsible.
Man, we're just darn glad to talk to one of the 1%ers. So
exactly.
Well, no, the reason why mutual funds don't do all that well, I actually look. Okay, listen, I have a BS in chemistry with a minor in physics. So what I'm really good at is going into chaotic situations and finding the trends.
Okay, so you're the only guy who knows how. I mean, imagine how many thousands of PhDs are on Wall Street getting paid humongous amounts of money and have better trading platforms than you, better research. I mean, think of the odds.
A faster connection to the exchanges.
So,
hey. Listen, email me and I'll show you my tracker.
You know how to reach us.
Well, you got our email addresses.
Yeah.
Okay, Matt, all our stuff's at.
Put your money where your mouth is. Have somebody talk to me. Come on.
Why would we want to? If you want to show us how good you are, dude, just send it to us.
We'll
it's easy.
Yeah.
It's so easy.
I'm making money on the market. Why would I make
Then why are you calling us?
Matt, dude, congrats.
I'm enough to see the trends.
Congratulations. Matt, I'm so proud of you.
We're very pleased.
Matt, 15% of mutual funds outperformed the lousy S&P 500 over the last 5 years of large growth mutual funds. That just tells you that, I'm not doubting that you're the most brilliant guy to trade Wall Street in the history of humanity. I can't prove it one way or another. Now, if you want to send us your audited financials of all your trades, with tax returns to back them up, I'll give you my address, don@vestory.com, don@vestory.com.
Bill Higgins, our research guy's right here waving his hand. Bill@vestory.com.
Bill@vestory.com.
He reads this stuff every week. Trust me.
Bill's a data hound.
Yeah, we're always looking for these things, so we just can't find them. But we wish you well. We're happy for you.
Again, Matt, not upset, but just telling you, we think that we would be doing our audience a huge disservice if we suggested that they go trade the market. That's just dangerous. 855-935-TALK is the phone number. Ramona, it's your turn. Welcome to Talking.
Actually, we're going to Amy first. My bad.
Oh, Amy, you're next. I'm sorry. Tom messed up the order.
Hi, Amy.
That's okay. Can you guys hear me?
We hear you just fine.
Okay. Well, I'm sorry you just had a conversation with that Matt guy. But anyway, that I have a question about my pension plan. So I was recently laid off from a large telecommunication company after 20 years. And I had a 401k and a pension plan, and not just in full disclosure, I'm a terrible person when it comes to money. I spend way above
wait,
my
Ramona.
means.
Ramona, that means you're a normal person. Doesn't mean you're terrible.
Oh, yeah.
You're a normal person.
This is Amy, by the way.
Amy. I'm sorry. I look at my screen, I get confused because he's got them in the wrong order. You are a normal person if you manage money badly. The vast majority of America manages money badly.
Oh no. I think I'm you would not want me as a client or be married to me. I'm surprised my husband hasn't divorced me. I'm like really bad. I rack up credit card bills and
all right.
How can we help you be better?
Yeah.
That's what I need help with, because if I do this, if I keep making these same mistakes, I'm going to be single and poor. So I was laid off.
Yes.
And I racked up a lot of credit card debt, so I took money out of my 401k to pay off those credit card debts.
I was fearing that.
I knew that was coming. I mean, that wasn't a good idea, but it's over and done. What from this point forward?
It is. So now I have this money in the pension plan, but I'm concerned about, I don't know enough about pension plans and how safe they are. And
how much is in the pension, Amy?
What's it worth?
$40,000.
Okay, let me tell you the advice. How old are you, Amy?
48.
Okay, you're young. Trust me, you're young.
Yep.
You have a lot of time before you retire. I would, and I think Tom will concur, that if you can cash out that pension plan, probably the best thing you can do for your future is to take that pension plan, roll it over into an IRA, put it into a portfolio that has the potential to grow, and it's balanced for your risk tolerance. For example, go to Vestry.com, take the risk quiz. That'll help you determine what your risk tolerance is. Then use the funds at Vanguard. We talk about the total world index, total bond market. Create a portfolio that's really well balanced based on your risk tolerance. Leave it alone. Promise yourself that money does not exist. It cannot be touched. It's sacrosanct. Leave it alone.
Yep. And then get on with your life. And by the way, we don't feel bad about getting a call from Matt. Number one, it's a warm up. I got my in-laws coming tomorrow, so it's a good way to get started.
I like calls like Matt's.
And for those of you who believe you can trade your way to nirvana and you're doing it, God bless you. I don't have any issue. The issue I have is, and we weren't trying to doubt Matt. We're trying to doubt trading in general because we can't find a track record of long-term performance. That's it.
Well,
if you've got one,
we have found some in hindsight, but the problem is it's been somewhere around 1% of active managers.
Pardon me, yeah.
And the problem with that is that the top 1% of those over the next 5 years, over half end up being in the bottom half of performers are out of business. So there's no persistence to performance either.
My argument is you hear ads for this all the time. Many of you grew up believing in a stock picking contest. Many of you think that's investing. And what we're trying to tell you is it decidedly is not.
It's gambling. But guess what? There are successful professional gamblers, too.
Tom and Don are talking real money.
If you're looking for a nice short podcast to tide you over between episodes of Talking Real Money, check out Money 30. Money 30 podcasts are between 2 and 4 minutes long, and they're available at every major podcast service, including Apple Podcasts, or you can visit money30.com.
For your real life and real future, Tom and Don are talking real money.
Now, the Securities and Exchange Commission has been struggling with trying to find a way so that the customers know whether or not what is called a duly registered advisor or a dual hat advisor, try to tell them the fiduciary advisor from the merely suitable advisor, and they haven't figured it out. Well, I have. It's called Advocaps, and you make them wear a hat. Go check it out at TalkingRealMoney.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That should keep the lawyers happy.